G'day, boss. Thanks for the question, mate. So what about individuals wanting to put a family trust, form a family trust in order to put his mortgage-free house in it? Would you help with such? Now, there's a couple of reasons why I wouldn't do this. And once again, this is general advice, so make sure that you do your own research and consult a tax professional or financial advisor to make sure that you are doing the right stuff. So when we're talking about a principal place of residence, I'm just assuming that it is your home. The reason why we typically don't put that in a family trust is that when your home is owned in your individual name, it is a CGT exempt asset, meaning that any capital appreciation that you have on that property, you will not pay tax for capital gains. Once we move it into a family trust, irrespective of whether you are living in it or using it as an investment, you will forfeit the CGT exemption, and therefore it means that in the future, if you do sell it, that you will be subject to paying capital gains tax on that transaction. Secondly, moving property from one structure to another, no matter the circumstance, is a very, very costly exercise. And because of this, we typically don't advocate it. Because when you transfer that property, you're going to have to pay stamp duty again and some legal fees. So let's call that about 5% of the value of the transaction. And then you've got to work out, well, what's the material benefit of doing so? Is it for asset protection? Well, it's kind of like an insurance policy. If something goes wrong, that largely depends on the risk of your profession, whether you're conducting a business, so on and so forth. Secondly, is it for tax minimization? Considering the first point, if it is your home, you're going to lose some tax exemptions, so that's not a good idea. If it is an investment property, well, it's a matter of what then we need to do with that income in order to put you into a net better position. So let's consider that it is an investment property. You've already bought it, you paid stamp duty before, you're going to have to pay stamp duty again. You are going to have income that you have the ability to split. Let's say, for example, you're in the top marginal tax rate, so you're paying 46.5 cents tax in the dollar. As a result of putting it into this trust, the income is taxed potentially at 30% because you put it into a bucket company. Potentially, you've got lower tax beneficiaries that you can distribute to as well. Now, let's say for argument's sake that you've got 50 grand a year in income that's being produced by this property. Once again, I don't know your situation. You're going to pay, on average, let's say about 15% less tax. So in that particular case, we're talking $7,000. Let's say it's $1 million property. You're gonna have to pay at least $50,000 in fees. Simple maths is going to take you about 3 years and a bit in order to recoup your cost of the transfer. And then from there, you hopefully have a net benefit from that position onwards. So for those reasons, you may seriously want to consider it and make sure you get some advice. These are kind of some general rules of thumb. If you do want some help navigating this, whether it be this particular situation or looking for opportunities to set up the right tax structures to support you, we can definitely help. So send me a DM or drop any comments below and happy to answer them in future videos. Thanks for the question.